Hello, everyone. I'm David Elizaga, CFO at eDreams ODIGEO, and I will take you through a first quarter fiscal year 2026 results presentation for the 3 months ending on the 30th of June 2025. Last year, eDreams ODIGEO delivered an exceptional fiscal 25, not only achieving but surpassing its ambitious 3.5-year targets. Building on the strategy from our January 2025 Capital Markets Day, we have launched tests into new markets and are testing innovative new products, for example, monthly subscription fees for a subset of our customers. Our momentum has carried into the first quarter of fiscal 26, and we're proud to report that we have again met in the first quarter all our targets and are on a clear path to achieving our goals of Prime members and cash EBITDA for the full year. Our Prime business is financially strong, and our overall profitability continues to improve and delivers outstanding margins. Building on the strategy from our January 2025 Capital Markets Day, this momentum has carried through the first quarter of fiscal 26, and I am proud to report that we've met all of our targets and are on a clear path to achieving our goals of Prime members and cash EBITDA for the full year. I'd like now to walk you through the key highlights from today's presentation. First, the performance highlights. The Prime subscription model continues to be the engine of growth. Our model remains the core driver of our success. We've grown our membership to 7.5 million, adding over 1.2 million new subscribers in the past year alone, and added 205,000 in the quarter, which is at the higher end of a guidance of 190 to 210,000. Subscriber growth is translating directly to our bottom line. Cash EBITDA increased by 8% to 39 million euros, hitting our target. The revenue from Prime members is now very significant. 72% of our cash revenue margin, a 5 percentage point increase in the quarter year on year. Our Prime business has a robust model, is delivering growing profitability and achieving outstanding margins. We saw a 3-point increase in our cash EBITDA margin in the quarter year on year, driven by the increasing maturity of our Prime members, which leads to improved profitability and margins. Free cash flow, ex non-Prime working capital adjusted for one-offs, stood at 11.4 million euros from 20.4 million in the first quarter of the previous year. The reduction is due to an increase in taxes paid during the quarter, which increased mainly due to higher profits and a change in Spanish regulation on advanced tax payment, as well as an Italian tax litigation. Other highlights from the quarter include: we reported a net income of 13.6 million euros, a major improvement from a loss in the previous year, and our adjusted net income was even better at 23.6 million euros, which we believe is a more reflective measure of our business's performance. Second, we focus on shareholder value. I want to take a moment to discuss our recent actions related to capital allocation and shareholder value. We're committed to not only growing the business, but also ensuring that our shareholders benefit directly from our success. On capital allocation and liquidity, we are excited to announce that as of last Friday, we have already repurchased 80% of the 20 million euros program we announced in May. This has contributed to a significant increase in our average daily trading volume, which now stands at 2.5 million euros in the European Composite Index. Given the success of this program and our strong financial position, our board of directors approved a new additional share repurchase program of another 20 million on Monday, the 1st of September. The start date of such new program will be announced upon expiration of the current share repurchase program. This is a clear sign of our confidence in the company's value. Second, we have made remarkable progress in improving the liquidity of our equity. During 2025, our 10-day rolling average liquidity in the European Composite Index increased by a staggering 492%. Our average daily volume in 2025 is 2.5 million euros per day, and in August we reached 3.9 million euros, a dramatic improvement that makes our stock far more accessible and attractive to investors. In terms of remuneration to shareholders, at our annual general meeting on July 9th, our shareholders unanimously approved a multi-stage capital reduction plan. The first stage involved the redemption of nearly 3 million shares that we had previously acquired through our buyback program. These actions demonstrate our strong financial position and our proactive approach to managing capital, improving liquidity, and providing tangible returns to our shareholders. Third, our positive outlook. Looking ahead, our outlook is very positive. For the full year, we project to add 1 million new Prime members and generate cash EBITDA in the range of 215 to 220 million euros. We're also confident in our ability to generate between 103 and 108 million in free cash flow ex non-prime working capital. We have revised the guidance to include the changes in taxes mentioned above, and this is partially compensated by interest savings from the refinancing. Our long-term growth fundamentals are strong, and we believe we are well positioned to continue momentum into fiscal years 2027 and 2028, where we expect Prime members to grow in excess of 10%. eDreams is significantly underpenetrated in its main markets, is testing new markets and products online, and has a strong fundamental growth potential beyond fiscal 25. In sum, Prime's proven model continues to drive very strong revenue and profit growth. And simultaneously, we have delivered a significant uplift in profit margins. We believe we have the right model, the right people, and the right structure to seize and deliver on the exciting shareholder value-creating opportunities ahead of us. Now, this slide clearly and visually demonstrates the growth and financial strength of our Prime business and its impact on our overall profitability. Our Prime business has a robust model, is delivering growing profitability and achieving outstanding margins. On the left, you can see how our cash marginal profit margin for Prime has consistently increased over the last 5 years. Our cash marginal profit margin for Prime started at 42% in the first quarter of 25 and has now reached 49% in the first quarter of 26. This represents an impressive 7 percentage point increase over the last 12 months. This trend shows that as our Prime members become more established and engaged with our services, the profitability of each transaction improves significantly. This strong performance from Prime has a direct and positive effect on our company's overall profitability, as shown on the cash EBITDA margin on the right-hand side, which has also improved consistently, mirroring the success of our Prime business. The cash EBITDA margin has increased from 19% in the first quarter of 25 to 26% in the first quarter of 26, also a 7 percentage point improvement over the last year. This correlation demonstrates clearly that the maturity of our Prime membership base is a direct driver of our improved overall margins. In conclusion, our Prime business is not just growing, but it is also becoming increasingly profitable. This improved efficiency and profitability from our Prime members are directly contributing to the significant growth we see in our company's overall cash EBITDA margin. This slide illustrates our strategic shift to a subscription-based model and highlights how our strong Prime growth is successfully offsetting planned decline in the non-subscription side of our business. This trend shows that we are successfully shifting our business model and that Prime is without doubt now the dominant revenue source. Today, Prime accounts for 72% of our total cash revenue margin. That's a significant jump from 63% last year. The shift to Prime is not just about revenue, it's also about profitability, as shown on the right. Our total last 12 months cash marginal profit increased by a notable 27%, from 225 million to 287 million over the last year. This is a direct result of the high profitability of our Prime members as the maturity of them increased. While our non-Prime marginal profit declined, the Prime profit surged, driving a substantial improvement in our overall profitability. Consequently, Prime now accounts for 87% of our total cash marginal profit, proving that our subscription model is not only growing our top line, but also dramatically improving our bottom line too. Our strategy is working. The strong and profitable growth of our Prime business is more than compensating for the anticipated and planned decline in our non-subscription business, proving our model is sustainable, effective, and primed for further growth. Now we'll take you through the financial results in more details. In the first quarter of fiscal 26, the Prime model continued to show that it is the engine of our growth, and we saw significant improvements in profitability, driven primarily by the increasing maturity of our Prime member base. Looking at Prime's impact on profitability and the drivers behind that growth, cash marginal profit, a key measure, grew by 8%, reaching 65.1 million. This shows that our business is not only growing, but each transaction is becoming more profitable. This improvement is due to the maturity of our Prime member base. As members stay with us longer, the profitability grows, which is evident in the 10% increase in cash marginal profit per Prime and its margin increasing by 4 percentage points over the past year. This is having a positive ripple effect on our entire business, as our overall cash EBITDA margin improved by 3 percentage points, from 21% in the first quarter of fiscal 25 to 24% in the first quarter of fiscal 26. Cash EBITDA for the quarter reached 39 million, within our target range of 38 to 40 million euros, marking an 8% year-on-year increase. Looking at revenue performance, in the first quarter of fiscal 26, we have observed a few key changes in our revenue margin. While our overall revenue margin increased by 8% compared to the same period last year, our cash revenue margin saw a 6% decrease. This shift is primarily due to a 23% growth in Prime revenue margin, driven by a 20% increase in Prime members. However, this growth was largely offset by a 20% planned reduction in non-Prime revenue margin. Cash revenue margin for the Prime segment remained in line with the first quarter of fiscal 25. While member growth was a positive factor, it was offset by a test of monthly subscription fees for a subset of our customers. As mentioned in our Capital Markets Day in January, we are very focused on consumer feedback on the overall proposition, and will continue to explore and test new propositions over the coming years. As a result of research we have done, some customers tell us they prefer monthly subscription, which in turn may lead to higher engagement and customer satisfaction. We are testing this to see if it is attractive to us economically in the longer term. In the meantime, it has an impact on deferred revenue while we assess what is best for the business long term. Let me explain briefly. For the portions of our traffic where we test the monthly subscription, we have the negative economic effect of cashing in the subscription fee gradually, as opposed to the yearly fee in advance. This is the reason for the negative change in deferred revenue of the first quarter. In summary, the maturity and retention of our Prime members are the most significant drivers of our profitability, leading to strong and tangible improvements in our financial performance. Let me now move to the cash flow statement. In the first quarter of fiscal 26, we end with positive net cash from operating activities of 23.9 million euros, following the successful expansion of the Prime member base, which resulted in higher adjusted EBITDA. In the first quarter of fiscal 26, we had a working capital outflow of 15.3 million compared to an inflow of 6.8 million in the same period of the previous year, impacted by a lower average basket size and a decrease in Prime deferred revenue due to the test of monthly subscription fees, partially offset by an improved hotel working capital. Income tax paid increased from 100,000 euros to 11.6 million. There are three main reasons for this increase. Firstly, we have started to generate positive profit before tax. Secondly, the Spanish regulation has limited to 50% the amount of in-year losses of legal entities within a tax group, and will reimburse in cash the remaining 50% over a 10-year period. And thirdly, in order to appeal in a tax litigation in Italy, we have paid 2 million euros. We have invested 15.5 million euros in the first quarter of fiscal 26, an increase of 0.9 million euros as we capitalize our software. Cash used in financing amounted to 33 million euros compared to 6.2 million from financing activities in the first quarter of fiscal 25. The variation of 26.8 million euros in financing activities is mostly due to the impact of our recent refinancing. At the end of June, we refinanced our 2027 notes, expanding the maturity by 3 years and lowering the coupon from the previous 5.5% to 4.875%. This is the lowest coupon of any euro issuer in our credit rating of B+ in the last 4 years. Additionally, we refinanced our super senior revolving credit facility, increasing the size from 180 million euros to 185 million, and initiated dialogue with additional relevant banks in Europe, which may increase the size by another 20. Due to the refinancing, we show in our cash flow a number of one-off effects. These are detailed in slide 22 in the appendix. We paid 5.2 million for the early redemption of the 2027 notes. We paid in aggregate 6.5 million euros in fees for the refinancing. Please be aware that there are another 5 million euros in fees pending to be paid in future quarters. And we advanced payment of the interest on the 2027 notes of 9.2 million euros, which we would have normally paid in the second quarter. During the first quarter, we also invested 10.4 million in share repurchases, which is more than double what we invested in the same period last year. I would like to conclude today's presentation talking about our liquidity. I'm excited to share with you the significant improvement in our company's liquidity throughout 2025. Thanks to the success of our share repurchase programs and the Premier placement, our 10-day rolling average liquidity in the European composite has increased by an impressive 492%. This is a remarkable achievement in less than a year, with our liquidity rising from 0.7 million euros on November 12th, 2024 to 3.9 million euros on August 20th, 2025. This has resulted in an average daily volume in the European composite of 2.5 million euros per day in 2025. These significant improvements mean we are no longer the illiquid stock some of you may have thought of us, making us more investable and creating a compelling investment opportunity for both new and existing investors to consider. eDreams has a finely tuned model, fast growth, is self-funded, and has a huge opportunity ahead of us. We have demonstrated consistent delivery across all KPIs and have an exciting journey ahead.
Disclaimer. As described in the legal section on our website, c11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. c11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.